We are talking about why you should refinance, but we're also going to be talking about why you should not refinance home equity loans and home equity lines of credit. Thank you for joining me for this webinar. I'm your host, Frederick Middlebrooks, and so I'm going to be taking you through this journey throughout this presentation to just discuss with you some of the reasons that you should consider when deciding whether or not you should do a cash out refinance, whether you should look at a home equity loan or a home equity line of credit, or whether you should cancel all of them out and just stick with some other form of being able to take care of the expenses that you need to take care of. So we're going to dive on into it. Briefly, I will discuss or talk about a little bit what home equity lines of credit, home equity loans, and cash out refinances are. I'm not going to go too in depth with it because there are other videos on our YouTube channel. So if you go to Greatest Asset Community, that YouTube channel, subscribe to it, and you can follow us and stay up to date on all the videos that we're posting. But there are other videos that go more into depth in explaining home equity loans versus home equity lines of credit, cash out refinances, and the works, and a whole lot more. So I'm only going to give a brief overview right now before we dive into everything. But basically, a cash out refinance, in essence, replaces the current mortgage that you have on your home with a brand new mortgage. So whatever mortgage you have at whatever interest rate you have, what a cash out refinance does is it pays off your old mortgage and replaces it with a new mortgage. And most of the time that comes with a different interest rate. How much that interest rate is depends on what interest rates are at the time when you do a cash out refinance. A home equity loan or a home equity line of credit access the equity above what you currently own your home up to what your home is worth. So for example, let's say that you have a home that is worth $300,000 and you still owe $200,000 on that home. That means that you have $100,000 worth of equity in your home that you can potentially access. So again, if you owe $200,000 on your home, the amount between what you owe and how much your home is worth is the equity in your home. And that's what you access when you take a home equity loan or a home equity line of credit out of your home. You're accessing that part that is above, between what you owe and how much your home is worth. So it does not touch your original mortgage when you do a home equity loan or a home equity line of credit. You're opening up a new second mortgage, if you will, to access that equity that you have in your home between what you already owe and how much your home is worth. So that's all I'm going to go. That's as far deep as I'm going to go into explaining what these are. But let's jump on into the presentation. So should you refinance or should you not refinance? Or should you do a home equity loan or home equity line of credit? We're going to talk about some reasons why that you might want to consider on why you should do a home equity loan or home equity line of credit. And we're going to talk about some reasons that you should not do a home equity loan or home equity line of credit. So why you should. First, consolidate debt. And we're going to go into all of these in a little bit more depth further along in the presentation. So consolidating debt is one reason why you might want to consider doing a home equity loan, line of credit, or a cash out refinance. Making repairs or maintenance to the home, improving your credit, lowering that monthly payment. I'll back up a little bit and say improving your credit is one that a lot of people don't know about. I'm going to give a little bit of an explanation to try to make it a little bit more simple in terms of understanding how you can actually improve your credit by getting a home equity loan or a cash out refinance, not the home equity line of credit, but with the other two, the home equity loan and the cash out refinance, there is an ability for you to be able to improve your credit. And lastly, you can get rid of that mortgage insurance as well. So that's something that can help you lower those monthly payments as well. So those are some reasons that you might want to consider in terms of why you should refinance or do the HELOC or HE loan, but a couple reasons why you shouldn't. At the top of the list, if you are irresponsible with money, maybe you have a gambling problem, maybe you have a spending problem, maybe you just aren't good with making good decisions with money. You like to buy a lot of stuff that doesn't hold a lot of value or add a lot of value to your life. In those instances, if you are irresponsible with money and money tends to leave your hands as quickly as it comes into your hands, you should leave that equity in your home. Do not take that equity out of your home, because if you just waste it and squander it, now you're going to be paying it back with interest. And if you run into hard times and you're not able to afford to pay that back, you could potentially lose your home. So you do not want to get in that situation at all. So again, if you are not responsible with money, do not take the equity out of your home and go use that money to do some foolish stuff with. Leave that equity in your home where it is safer and you can at least continue to have a roof over your head. And also, if you are going to use that money, playing a little bit off the first one, for things such as like a cash out spending, or such as a spending spree, or you want to go on a vacation or take a cruise, or there are better ways to save up for those things. Take the time, have a little bit more discipline in saving up to pay for those things in cash, not by taking equity out of your home. And so we'll talk a little bit more about that as well. But let's talk about the first question, and the most important question that you should ask yourself when deciding whether or not you should do a HELOC, a HELoan, or a cash out refinance is, what do I need this money for? Why am I taking out this money or this equity out of my home? And one of the things, I'll put this into two categories. One, am I using this to repair or maintain something that is going to be appreciating in value? That is the first category that I'll put this in. There are a few categories, but I'm gonna focus on just the two, because there are a couple of main reasons that a lot of people tend to take money out of their homes. One, are you going to use it to repair or maintain something that's appreciating in value? And as you can see, I've got the picture of the home there. And homes are typically something that appreciate over time. I'll get a little bit more into depth on utilizing your home's equity for this purpose as well. But if it's not that reason, are you using it for entertainment, vacations, maybe buying clothes, taking a cruise, getting a new car, buying those $1,500 concert tickets to whatever your favorite artist is? If you're using it for those reasons, you just want to be aware that the interest that you pay means that your expenses are going to cost more than what you might think they would cost. For example, let's say that you want those $1,500 concert tickets to whoever your favorite artist is. So you buy those concert tickets. Those $1,500 concert tickets that you charged on your credit card, you're now paying that $1,500 back with interest. And if that's on a credit card, that's at a 20-something% interest rate. So that's something you want to keep in mind, because if you're only making minimum monthly payments or somewhere above the minimum amount of monthly payments, you could be paying double or more for those concert tickets that were only $1,500. And if you had only just saved up $1,500, you could have only paid $1,500. But because you charged it on a credit card, now you're going to be paying more than that for tickets that were only worth $1,500. The same thing applies for a home equity loan and a home equity line of credit. If you have as well as a cash out refinance, there are interest rates associated with each of these. And so if you utilize that money to do something that's not building value or adding value to your life, you're paying that money back with interest. So it's going to cost you more than what that actual item cost you. So that's something that you definitely want to keep in mind when you're deciding whether or not I even need to take this money out to be able to utilize for whatever purposes you are considering utilizing that money for. So some food for thought for you. One, consolidating debt. And we're going to go through the list that you saw on the first slide with reasons that you should consider possibly taking out a HELOC, HELoan, or cash out refinance for. So with consolidating debt, high credit card debt equals high interest rates. So if currently, as of this recording, the average credit card interest rate is over 20%. That is high. Now, typically your home equity loans, lines of credit, and cash out refinances have interest rates that are much lower than credit card interest rates. So because of that, if you were to take out equity out of your home and use that money to pay off these high interest rate credit cards, thereby consolidating that debt that you have on all these credit cards into this money that you took out via HELOC, HELoan, or home equity line of credit, or excuse me, HELOC, HELoan, or a cash out refinance, then you are going to be lowering your interest rate that you're going to be paying every month. So you're paying less money in interest every month, which means that you're having more liquid cash that you can access every month. And you could also use that extra money that you're saving to put towards the principal of that debt and get that debt paid down even quicker. And so that's another thing that you also want to keep in mind is, hey, I can consolidate all my high interest debt into lower interest rate debt. So now I'm saving on how much money I'm paying every month in interest, and I can put those savings toward paying down the principal balance. And it kind of works in a snowball effect to where now you're paying off that debt a lot quicker than what you would have paid it off by just making the minimum monthly payments on that credit card debt. So that's something you want to consider when you are looking at consolidating debt. That could be a good option for you when taking out money out of your home. Also, one of my favorite reasons for utilizing or accessing your home equity is to make repairs or maintenance to your home. Now, I broke this down into two parts, one for habitability and one for value. So we're going to tackle the habitability first. So when looking at the habitability, this is referencing, is your house safe, sound, and sanitary? Basically, is it structurally sound? Is it safe to live in? You know, you don't have the ceiling caving in on you. You don't have, issues with mold or anything like that in the house. And you want to make sure it's sanitary as well. So speaking on the habitability, let's say, for example, if your roof is leaking, that poses two issues. One, not only do you have water leaking into your home, which is causing damage to the wood or the framing of the home, but moisture in your home also creates an atmosphere where mold can grow. And if you have mold growing in your home, now that's an unsanitary environment for you to live in. So getting your roof leak fixed is something that you want to take care of. If you have to replace your whole roof, you want to replace that whole roof, because you don't want to be living in a house with mold. That's unsanitary. You don't want to be living in a house where the leak is now causing wood in the framing of the house to start to rot, because now that's going to be even more expensive with you having to replace rotted wood supports or struts that are supporting the roof of the house because you just let this leak continue on for so long. So again, that speaks to the habitability of the home. You want to make sure you get that stuff taken care of. And with that, I speak a little bit in it. If you go again to the YouTube page, check out Greatest Asset Community YouTube channel, subscribe to it. I have a lot more videos on there where I talk about ways that you can budget to save for these expenses that we know are going to happen as a homeowner. For example, you know, no roof is going to last forever. No HVAC system, no furnace. No furnaces actually tend to last pretty long time. You got some homes with furnaces that have lasted for 20, 30 or more years, but no water heater is going to last forever. Stuff is going to have to be replaced. So I've got videos on there where I talk about how you can budget for these expenses. Just to briefly give you a sneak peek into one of them, where I talk about, for example, you know, your roof has a lifespan on it. If you know how long that roof has been on there, let's say if your roof lifespan is 25 years and that roof has already been on there for 17 years, you know, you've got 8 years left on that of life on that roof. If you don't know how long it's been on there, you could still get a good estimate if you had a home inspection done before you purchased the property. And you could say, okay, let's say we have 8 years worth of life left on that roof. And I know that a brand new roof is going to cost, let's say $14,000 in order to replace. So I've got 8 years before I have to spend $14,000 to replace a roof. So let me divide that $14,000 into that 8 years to find out how much I need to save each year in order to get a new roof when it's time for me to get a new roof. Now you take that number, divide it again by 12 to find out how much you need to save each month in order to have the money that you need 8 years from now in order to get that new roof. So that's some of the stuff that I talk about in the other video to help you budget as a homeowner. Every month, you just set that money aside. Set aside the money that you know you're going to need for the HVAC system, which is eventually going to have to be repaired and or replaced. Set aside the money for the water heater. Set aside the money for the roof. You set aside the money for these things, and I tell you how you can budget for it so that when it's time to replace the roof, you have the cash. You don't have to go borrow money to get that roof replaced. You have the cash to be able to replace that roof. However, we know that things happen in life, such as a recession, inflation, which is what we're in right now. And because of that, sometimes we're not able to save as much as we need to save because the cost of goods and services are increasing a lot faster than what our income is increasing. And so that is inhibiting our ability to be able to save money at the rate that we need to save it in order to make those repairs. So sometimes it is necessary for us to be able to take equity out of our homes in order to make the repairs necessary that are needed to be made to keep the habitability and maintain and upkeep our homes. And so in those instances where you need to take out the homes, I think that doing it for repairs and maintenance is a great thing. And the second part of that is the value. So I spoke of the habitability, but the value of the home is the second part of that, which is equally important, especially if you're going to be selling this home at any point in the future. It's equally important to hold that value. We have all seen homes that may have been sitting on the market and they are fixer-uppers. So they're homes that are in need of maybe a complete renovation, maybe a partial renovation, whatever it might be. You find that those homes are often listed well below what comparable homes are listed at in a similar area. And the reason is because those homes need so much work done to them. When you need new flooring and you need new walls put in, or you need paint and you need a new roof or a new HVAC system, the more stuff you need, the lower that home value becomes, because now whoever purchases that home is going to have to put a lot more money into it. So in order to maintain the value of your home, you are going to need to upkeep that home and maintain that home appropriately. That's how your value continues to increase. So as we stated earlier, homes appreciate over time, meaning that they get more valuable, more costly, more expensive over time. However, that doesn't happen if you don't maintain and upkeep that home. Your value of your home can actually stay flat, or it can decrease if you don't maintain and upkeep that home. So if you wanted to sell your $300,000 home for $450,000 later, you're going to need to maintain and upkeep that home, which again plays into you living in a habitable place that's safe, sound, and sanitary. But it also plays into you maintaining the value of your home and making sure that your home continues to appreciate over time so that you can sell it for top dollar later on down the road. So harped on that one a little bit, but that one again is one of my favorite reasons in terms of utilizing the home equity, the equity in your home for those maintenance and repairs. So moving on, improving credit and lowering your interest. So this is one that a lot of people don't know about. However, I'm going to do my best to try and explain how you can actually improve your credit score by taking out a home equity loan or a cash out refinance. You cannot do this with the home equity line of credit. And that plays into the installment debt versus the revolving debt. So utilizing my credit card example from earlier, you've got 4 credit cards. Each of them have a $5,000 limit on them. That's $20,000 total that you could get into credit card debt with. Now let's say that you max out those credit cards. So now you have $20,000 worth of credit card debt in maxed out credit cards. Because those credit cards are maxed out, that is hurting your credit score. Now, if you were to take out a home equity loan or a cash out refinance and use the money from the home equity loan or the cash out refinance to pay off the balances on all of those credit cards. So essentially you take out that loan and you pay off the $20,000 that you owe on the credit cards. That helps your credit score because credit cards are what are called revolving debt. And so revolving debt is debt that when you pay it down, you can charge it back up again. So like credit cards, you can charge a credit card up and then you can pay it down and you can charge it up and pay it down. And that's why they call it revolving debt, because you can charge it up, pay it down, charge it up, pay it down. Installment debt is debt that once you pay it down, it's paid off. You don't have that debt anymore. So we're talking about things such as your car note, or if you got a loan to buy furniture, or if you got a personal loan from a bank, that's an installment loan, meaning that once you pay off your car is paid off. You can't charge up more money on your car. It's paid off. You're done. Once you pay off that furniture, once you pay off that personal loan, that's it. You've paid it off. It's done. But credit cards and home equity lines of credit are revolving debt, because you can pay it off and charge it back up, and pay it off and charge it back up again. So revolving debt, when it comes to your credit, is looked at differently and treated differently than how installment debt is treated. So if you have $20,000 worth of maxed out credit cards, that is hurting your credit score. Even if they're not maxed out, even if they were charged up to half the credit limit, that's still hurting your credit score. So let's say you have $20,000 worth of maxed out credit cards, that's hurting your credit score. But if you pay those off via a home equity loan or a cash out refinance, now that bumps your credit score up, because your credit card balances are now reflecting zero. The trick is to keep them at zero. Don't go charging those credit cards back up again. But now that your credit cards are showing a zero balance, even though all of that money is sitting in a home equity loan that you took out or a cash out refinance, those are treated different than how your credit card debt is treated. Your credit card debt, again, with a maxed out credit card, is going to hurt your credit score a lot more than you just transferring that debt over to a home equity loan or home equity line of credit, which is a home equity loan or a cash out refinance, which is a installment loan. And now that does not hurt your credit score as much with $20,000 sitting over here. So that's how you can improve your credit. And in addition to improving your credit, you're also lowering your interest rate, because as we mentioned earlier, the average credit card has an interest rate of over 20% right now. So by transferring that debt from credit cards over to a home equity loan or a cash out refinance, you are essentially not only improving your credit score, but lowering how much you're paying monthly in interest, which means that you have more residual cash that you can use to get that debt paid down even quicker. If you can't tell, I'm a big fan of keeping your debt low and not just going crazy with the debt. I say that even though I'm a loan officer and my job is to do mortgages for people, I still believe in being financially responsible, not going crazy with charging up credit cards. And I know it's been hard right now with interest rates being what they are, and also with the economy being what it is with inflation and everything. However, I am a big proponent of being debt free. And I think that owning a home simultaneously is a good thing to do. And I think a mortgage is a great way to accomplish that. So I don't see a conflict there. However, going back to my presentation, that is how you can improve your credit and lower your interest rate at the same time. So continuing on, you can lower your monthly payment. Now that kind of speaks for itself, because if you have a lower interest rate on your home, you're going to have a lower monthly payment than if you had a higher interest rate on your home. It's pretty basic math. Don't have to spend a lot of time there. And this is speaking to a refinance. You can do a rate and term refinance or a cash out refinance. Rate and term just means that you're just doing that. You're refinancing your home to get a new rate and a new term. The term being how many years you have to pay off that loan, and the rate being whatever interest rate you have. So you don't get any cash. A cash out refinance being you get cash out of your home in addition to refinancing it with a new rate and term. So with that, you again have a lower interest rate, you have a lower monthly payment. So pretty self-explanatory there. And lastly, getting rid of your mortgage insurance. This is one reason that you might want to do a rate and term or a cash out refinance is to get rid of that mortgage insurance. Now, Depending upon how much equity you have in your home, you might just want to stick to the rate and term and not do the cash out, because if you take out enough cash, you could eliminate your possibility or opportunity to do to get rid of your mortgage insurance. And so to explain this a little bit, the 80% loan to value ratio with a conventional loan. So if you bought your home as an FHA, you had mortgage insurance. Every FHA loan, when it's originated, has mortgage insurance. If you bought your home as a conventional loan, if you put down less than 20%, you have mortgage insurance, because conventional mortgages require mortgage insurance if you put down less than 20%. So for example, let's say that if you have a home that you purchased, let's say that home is worth $100,000. If you owe $80,000 or less, you don't have to have mortgage insurance. But if you owe more than $80,000 on that $100,000 home, you have to have mortgage insurance. So what are some of the ways that you can get rid of this mortgage insurance? Regardless of how you purchased your home, if you purchased it as an FHA, or even if you used a non-QM loan or a non-qualified mortgage, again, check out the YouTube channel, Greatest Asset Community, because I talk about non-qualified mortgages, DSCR loans, bank statement loans, all of that stuff in the YouTube channel. It's a lot of great content there. But getting back to my presentation, if you purchased a home, let's say under an FHA loan, you have mortgage insurance under that FHA loan, and you will for either the life of the loan, or if you put down 10%, then you're going to have it for the first 11 years of that loan. So if you purchase that home, you have mortgage insurance. Now, let's say over 3 years or over, the next few years, you've been making on-time monthly mortgage payments. So you've been putting equity in that home through amortization, which is you making those mortgage payments. But also over that time, your home has been appreciating in value. It's been getting more and more valuable. So now that $300,000 home 3 years later might be worth $335,000 or $340,000. So now you've got even more equity. And again, you only need to get to 80% of what you owe versus the value of the home. So if you purchased it for $300,000 and you only put, let's say, 5% down, that means you still owe 95% of the value of that home at the time that you purchase it. But several years down the road, now that home is worth even more. You don't owe even more, you owe less, because your principal balance goes down over time. So now 80% of the new value of this home 3 years, 4 years down the road might be above what you owe, meaning that you can now refinance your home into a conventional mortgage and get rid of your mortgage insurance. And by getting rid of your mortgage insurance, that lowers your monthly mortgage payment, because depending upon what your credit score is and a few other factors, your mortgage insurance could cost you, sometimes it could cost you 60, 70 bucks a month. But I've seen some people with mortgage insurance that cost them over $200 a month. So that can greatly reduce how much you have to pay in your monthly mortgage payment when you are able to eliminate that mortgage insurance. And doing a rate and term refinance is one way that you can eliminate that mortgage insurance and save yourself some money in the long term when it comes to your mortgage payments. So that's another reason why you might want to consider doing that refinance, is to get rid of that mortgage insurance. So to sum it all up, using equity out of your home, it can be helpful or it can really be hurtful to you. It's up to you to decide whether or not it's something right for you. My job as a loan officer, and just being passionate about the mortgage industry as a whole, is to educate you on all of these options that are available to you, show you how you can utilize these options to your benefit. And if you would like, you can reach out to me, because I can also take a look at your situation and say, you know what, based on what your income is, what your debt is, what your credit score is, what your future goals are for home ownership and finances, this would be my recommendation on the route that you should take to help you reach your home ownership and financial goals. So I also do that for clients that I work with as well, so that they have the complete picture to help them navigate this very complex world of finances in general. So again, it's up to you to decide. I leave that up to every individual to make that decision for themselves. But I like to provide everyone with the information and the education that you need to be able to make those informed decisions. So that's all that I have for you. I greatly appreciate you taking the time to tune into this webinar. You can follow me on social media. I am on TikTok and Instagram, GA Loan Officer. That's Greatest Asset Loan Officer. So GA Loan Officer on TikTok and Instagram. Please do follow me on those channels as well, but do subscribe to the YouTube channel. That would really help me out a lot. Greatest Asset Community. We're putting out new videos every week to try and just keep you informed, keep you educated, help you to make better decisions when it comes to home ownership and finances as well. So that's all that I have for you. Thank you again for taking the time to tune in. Look forward to seeing you in the next one. Take care and be blessed.